morning, everyone. We are going to get started right at 9 a.m. Thank you all for getting on this morning. All right, Jeff, you ready to get started?
Yes, I am.
Excellent. All right. Good morning, everyone. My name is Ted Harris. I am with the Pennsylvania Petroleum Association. I would like to thank you all for getting on this morning. This is a part of our monthly webinar series. We normally host this webinar on the first Tuesday of each month. We had to make an exception with this month, so thank you for anyone that was registered last week and anticipating on getting on. for your willingness to switch and get on this morning. Before I introduce Jeff, I would like to just remind everyone that you are going to be muted during this webinar. We encourage you to ask questions, and you can do that by using the question feature on GoToWebinar. And once Jeff gets through the presentation, we'll go back and I will essentially ask Jeff the question, and I'm sure he will, answer it. And if for some reason we don't get through it, I will connect you with Jeff after the fact. So with that being said, I would like to introduce Jeff Simpson. Jeff is the managing director of Angus Energy's Advisory and Finance Group and brings to Angus over 2 decades of fuel industry experience, including 15 years in the financial, banking, and risk management areas. His team specializes in financial planning, bank relations, acquisition structuring for fuel distribution companies throughout the Northeast. Jeff has assisted fuel dealers, both large and small, in maximizing profitability, restructuring debt, and securing the capital necessary to effectively operate and grow. Previously Vice President of Energy Lending at Citizens Bank in Boston, Massachusetts, and a Director of ReRen Energy Advisors in Hartford, Connecticut. Jeff is a frequent speaker on topics of forecasting and analysis, including improving bank relations and commodity and weather risk management. So that being said, Jeff, I will hand it off to you. Thank you very much.
Okay, great. Welcome, everybody. Thank you very much, Ted. I appreciate the invitation to speak today, and I want to thank the Pennsylvania Petroleum Association for having us. Just as a quick background, we work with quite a few companies in Pennsylvania. We really work with companies all around the Northeast. I'm a native Pennsylvanian myself, so it's good to get back quite a bit to the state where I grew up. We really work with companies of all sizes, as Ted mentioned. We're going to touch on some topics today, which I think are timely. They're always timely, but we're going to touch on some relatively painful financial analysis measurements that I think everybody in the industry should really know. We're also going to touch on some financial best practices that we share with our clients. And we're also going to touch on weather hedging today. I know that's something that many of you in the industry have taken up and started to do in recent years, but most still do not. So I want to take some of the mystery out of that today as well. So who are we? We have at Angus Energy a team assembled that's involved in a number of things. You may know us for our hedging and trading activity over the last 25 years. We also are heavily into business intelligence software with our Bright product. And the group that I'm involved with is called Angus Advisory and Finance. Our particular team is based in Connecticut, so we're sort of central to the industry, and we have clients all around the Northeast and Mid-Atlantic. But we're really made up of people who are financial people first. We come from a background either in banking or in pure finance, and we're really structured so that we can support companies in this industry, because we realize that most companies in the industry don't have a big financial department. So they're always in need of additional financial support, and that's the area that we've been constructed to support. We really, from our standpoint, act as part-time CFOs for companies. We do anything from basic budgeting, which often isn't very basic at all, but we start with budgeting. And we work all the way up to assisting companies with structuring acquisitions, mergers, and dealing with bank refinances and location of capital. Our main goal is to help companies become more profitable. That's sort of an Angus-wide mantra that we have. But we want companies to become more profitable. And in our particular group, it's really about consistency in planning and tracking. Our tagline is, don't make excuses, make improvements. In my experience, success really starts with measurement and accountability. We find that a common thread in underperforming or struggling companies is a lack of a detailed plan or a lack of understanding of appropriate profitability goals based on the size of the operation and the debt structure. And it's our job for our clients to help them see where they need to be and then help them devise a plan to get there. One of the things I saw back in my banking days, I spent the better part of a decade as a lender, specifically to the fuel industry. And one of the things that I saw that struck me early on was how few companies really have a plan. How few have a budget. A common request that we would make is, can you send us your 12-month budget? And I'd say in probably 9 out of 10 or maybe 14 out of 15 cases, there wasn't one. And that's something that I think as an industry we've got to change. And we've found a lot of success in assisting companies in putting that in place and holding them accountable. What do we offer? We offer planning, as I mentioned. By starting and developing a balance sheet and a cash flow and profit and loss projection, that really gives us a baseline to understand where the company needs to go, and it allows the owners of the businesses to track what they need to be doing in the heat of the battle. As we all know, for those of you who are retail heating oil and propane companies, there's just a few months to make the hay, and you've got to hit it right. So it's really about making sure we don't miss those opportunities. By going through this first step process, this preparation of a budget, it allows us to determine what changes we need to make in order to best position the company to negotiate with its financing partners, to achieve the goals it wants to achieve, to position itself to make an acquisition, whatever the case may be. Tracking. We do a lot of tracking for companies where every month we're comparing their financial results with what we targeted, and then having discussions with owners, and that's been a very effective process. Most of the people we deal with as clients, we've been dealing with for many, many years. It's an ongoing relationship. We do a lot of reviewing strengths and weaknesses, analyzing balance sheets. Based on my background, a lot of negotiation with banks and helping companies really relay to the bank what their goals are, and also helping companies understand what the bank is looking at, so that it doesn't become a frustrating endeavor for both parties. We really want to act as an interpreter of sorts for our clients. We negotiate with suppliers. It's not uncommon that we'll be working with a client who has had some difficulty in paying off a supplier on time. So we will work with both parties to put a plan in place so everybody's happy and the relationship can continue in a healthy way. And finally, acquisitions. As I mentioned, we do a lot of assistance with due diligence and planning for acquisitions. We're not a broker. We really are just more assisting companies in getting the plan in place and improving profitability. Weather hedging, something that I think everybody in the industry should understand. Whether you do it or not, please take the time to understand it so that you know the benefits and also the risks, but really understand the benefits of what weather hedging can do for a seasonal operation. The members of our team here at our office in Connecticut are members of the National Futures Association. Angus Energy as a whole is a registered commodity trading advisor, and that's a designation that we've had for about a year and a half, and that allows us to really have in-depth discussions with customers in the area of hedging, structuring, and commodity trading. Our hedging advice in our group here really tends to focus on appropriate weather hedging structures for our clients, and we utilize the detailed budget that we've developed in order to make sure customers and our clients are making the best decisions about what they should be doing in the way of a weather hedge. You'll find, if you're not familiar with weather hedging, there's a lot of similarities to regular commodity hedging. For those of you who have used options to hedge heating oil, propane, or other fuels, and we'll go over that towards the end of the discussion today. Because we're a commodity trading advisor, I just want to go through a regulatory disclaimer that we're required to share with you. Just keep in mind that everything we go over today is really general in nature. It's not tailored to your specific company. I think some of the examples that we'll go over you can use to arrive at what would be best for your company. But keep in mind, everything we're going over today are just generic examples. And we really would recommend that you talk to a commodity trading advisor to assist you in structuring as you're looking at weather hedging or any other type of hedging. As I mentioned, we're registered with the National Futures Association as a CTA. Anytime there's trading, you just have to be aware that past results are not necessarily indicative of future results, and there is risk of loss in trading, and it can be substantial. So you should carefully consider what you're doing, and considering whether or not you want to enter into a trade or authorize somebody to do it, just be aware that you could lose all or substantially all of your investment or premium, and you may be liable for amounts above your initial investment based on the type of structure that you enter. So let's kick it off. What we're going to talk about today, I think, is really more extreme situations. What I want to get into today is about positioning your company to handle extreme situations, whether that's warmer than normal or a colder than normal winter. What are some of the considerations that you have? I think all of you, just by nature of being in the industry for some or many years, understand operationally what the impact is, but let's think about it from a financial perspective too. Let's start with a warmer than normal scenario. Let's say, for example, that the heating degree days over a winter are 10% lower than the 10-year average in your region. How does that affect you? Here are some things that we commonly see. Obviously, you're going to have lower gallon deliveries if you're in the heating oil and propane space. You're going to have lower service and installation sales, very common, that sort of tags along with lower gallons in a warm winter scenario. You're going to have some difficulty covering fixed operating costs and perhaps even debt payments. You're going to have to manage your full-time and part-time employees in a way that keeps your costs as low as possible to correlate with the lower earnings that you're making. You're going to have to deal with irrational competitive pricing. It just happens. You would think in a warmer than normal scenario, everybody would say, well, geez, I'm selling less units, so maybe I should increase my cost on those units. But as we all know, that's not what happens. There are a lot of people in this industry. Depending on the size of your business, your mindset is different. Obviously, there are many in the industry that are really just looking to continue to move products so that they can earn a paycheck, and I understand that, and I think larger companies understand that as well. So there's a rational competition out there, and you just have to deal with that. And then also, banking relationships can be impacted. This is something that we commonly are pulled into for new clients, and that is, helping them convey to their bank what's going on and what were the things impacting their company negatively as it relates to their loan requirements and their covenant requirements. Let's look at the other extreme. Say we have a colder than a normal scenario, but significantly colder. What are the impacts there? Overtime management. It's very common that we see situations where companies are going great guns with deliveries, going great guns with service, and when the dust settles at the end of the season, the profits aren't there that they expected, and that's has a lot to do with management of overtime expense and management of staff, management of part-time staffing. Banking relationships can be impacted in another way, and that's that suddenly lines of credit aren't adequate to get a company through the season, and that can be a scary thing. When you think about the value of your business, it really is the customer list value is the primary driving value of your business, and if you can't serve those customers, they're going to leave, and that can be devastating, and you can really see erosion of company value in that type of situation. So I'm always hyper sensitive to banking relationships and making sure our clients are out in front of these situations. Collections can become very, very critical during colder than normal stretches. As bills get bigger, payments slow down, and it requires an extra heavy lift on the part of staff in order to make sure that doesn't negatively impact you. Margin compression on program gallons. What I mean by that is, if, For those of you who are offering pricing programs, cap programs, fixed programs, you're making assumptions as you head into the winter as to what you're going to need to sell. And when those assumptions don't prove out in reality because it's particularly colder than normal, and suddenly you're forced to pick up at the rack at a higher price than what you assumed, that can really start to impact you negatively as well. And then obviously there's a lot of operating expenses that can increase, vehicle expense being one of them. So for those of you who maybe aren't involved in sort of the day-to-day activity with your bank, this is just a simple graph showing what happens over the course of a season with the cash flow of a typical business. Your company, depending on how strong it is, may not need to borrow on the line, but I can tell you that most do. And what this is showing is sort of a typical flow over the course of the year on a line of credit. And you can see in the early months, starting in January, February, March, how the line of credit peaks. And this is, it's showing as a negative cash situation, but that's really a borrowing on the line of credit in this example. And then as you enter into April and May, into the spring, and the receivables that you start collecting from the customers you sold to turn to cash, then you pay down your line, and ideally by the time you get to the summer, late summer, your line is paid down and it's at zero. And then as you get into the latter part of the year, in this case right around November, you go back into the line again because you need to buy product from your fuel supplier, and you need to wait typically 30 days to get paid by your customers. So this is the general ebb and flow of a cash flow cycle for a fuel company. And you can see here the peak was just about $200,000 on the line of credit borrowing. And if you look at the positive cash situation, that's really the profits that are generated, just under $100,000 in this scenario. What happens when it's warmer than normal? You can see that the cycle is more or less the same, but we start to see things change in its extreme. Here what happens is your borrowings on your line go down because you're not selling as much in the way of fuel, so your need to borrow goes down, and you can see in this scenario, instead of around $200,000, it dropped to $175,000 or so. But also, when you look at the positive cash situation later in the summer as you collect your receivables, it's not as high as it was in a normal scenario. Here we're only looking at about a $50,000 cash bill. What happens in a colder than normal scenario? Again, it's the same cycle generally, but your peak borrowings go up. So in the winter, instead of $200,000 in a normal year, in this scenario, it might be $210,000 or $220,000. And then in the summer, once you collect your receivables, you can see that things have gone up and you've made money. So it's important to just understand generally how things flow. What I would like to start with, just in assessing your ability about whether you're in a position to weather these abnormal situations, is look at some basic balance sheet indicators. And I'm not going to get too far into the weeds as it relates to financial indicators. And by the way, this presentation will be available to you after the fact, so don't feel that you need to quickly write all this down because I'm going to be moving pretty quickly through it. But balance sheet indicators are important, and what they do is they help dispel any false sense of security that you might get during a particularly warm stretch, or maybe you're sitting on a lot of cash that you've collected from customers. So these are important to understand, and the main one that I always focus in on first and foremost is called a current ratio. And what that does is really show if your company is exhibiting weakness at any point in the year. You may not feel it, but it shows that there could be an underlying problem. We're going to go over that. Basically, the definition of current ratio is your current assets divided by your current liabilities. So that's all of your assets that will turn to cash inside of a year, and all of your liabilities that must be paid inside of a year compared to each other. As I say, learn it, know it, live it. Know what your company's number is, and I'm going to give you some reference points to know whether you're in a danger zone or whether you're in a nice, comfortable zone. Accounts receivable aging. Understand your buckets. When I talk about buckets, I mean, what's 10 to 30 days, what's 30 to 60, what's 60 to 90. Know what your trends are within your company. and understand, what policies you need to have in place in order to make sure that your staff is maintaining acceptable levels in each of those buckets. And your line of credit balance, what's going on there? What's changed, either internally or externally, from last year to this year that could impact your line of credit need? Internal factors could be expansion of a customer, of a business line. It could be an acquisition that was made. It could be, something that was done that you purchased, whether it's a bulk plant upgrade or what have you, and you borrowed, cash in order to do that on the line. So you need to be very cognizant of that. And what external factors drive those assumptions? Commodity cost, how has it changed year over year? The weather, was last year warmer than normal and perhaps gave you a false sense of security? Has your supplier tightened up your supply payment terms? All of these things can impact your line need from year to year, and it's important to understand that. So let's quickly run through current ratio. Really what it is it's a comparison of your short-term assets to your short-term liabilities. And on the left are some very common short-term assets: cash, AR, securities you might have, usable inventory, and prepaid expenses. And on the right are common short-term liabilities, your accounts payable. Any money you've collected from your customers, even though it's nice to have cash, that's a liability. You owe that to your customers in the form of a service down the road. Your line of credit balance, that's a short-term liability. And any annual loan payments you have. If column 1, which is your short-term assets, are greater than column 2, then you're in a good position generally. That's an indicator of stronger liquidity. If column 2 is greater, meaning your liabilities are greater than your assets, then that's an area where the antenna should go up, and you really should start to analyze that and understand how far out of balance are you and why is that. If you're right around 1-to-1, that's sort of the industry average, and that's okay, but I really push our clients to have a better current ratio than just 1-to-1. Accounts receivable aging, just very quickly on this, this is an example of tracking accounts receivable by bucket. And in this scenario, this was an example we did last year for a company, about, roughly 2 million gallon company. And this shows over the course of the year what was happening within each of those buckets. And what's interesting here, I'm not going to dwell on it too long, is you can see the orange line is really what over 120-day receivables. The green line is over 30. Just looking at those alone, you can see as we come out of the winter period, it was edging up over the course of the year, and that's not a great sign. That's a sign that collections aren't happening the way they should be happening. And what we found in this situation was really what was happening is that the front end policies were not adequate. There were too many customers being given credit that should not have been extended credit, and that really led to them, having to write off some of their receivables as bad debt down the road. So by tracking things in this way, you really get a clear picture of what's going on. I also want to just spend a little time focusing on income statement indicators. So this is looking at your profit and loss. What are some things to just understand? Understand what your earnings before interest, taxes, depreciation, and amortization is. And, in any year where you had something that was out of the ordinary, you had a gain on the sale of a truck or real estate or something, sort of throw that out of the mix and understand what your company's steady state EBITDA is. It's important to understand. Operating leverage, not going to dwell on it today other than to say, always look for ways to improve variability in your cost structure. We work with a lot of companies that just have far too many full-time employees, and it's I understand the challenges of getting employees in, and the desire to carry them through the summer so you have them for the winter, but you really need to look hard at those cost structures and bring variability to your structure. Debt service coverage ratio, that's really what are your annual principal and interest obligations in relation to earnings. And cash flow leverage, how much debt do you have in relation to your EBITDA number up above. Here's the definition of EBITDA. I won't dwell on it here. I just gave you a quick definition just to keep it moving. Here on slide 20 is an overview of what you should be looking at as far as debt service coverage. Whether you have a covenant with your bank or not, I assure you the banks are looking at your ratio, and it's also very important to understand it so that when it comes time to acquire a company or acquire a piece of real estate, whatever the case may be, you understand that your company has been more or less tracking along at levels that the bank would deem to be acceptable. So when you go to ask for financing, you are well positioned to do that. A lot of times when we're working with clients who are struggling a bit, it may take a year to get to the point where they are finally able to go and have a discussion with the bank, and we help them triangulate where they need to be by looking at these ratios. Generally, banks want to see a debt service coverage ratio that's 1.25 times or better. So that's a good target for you as well. If the income on the left side of this column is 125% of all of the payments on the right column, that's an indicator that you've got a decent debt service coverage ratio. If that ratio is below 1 times, meaning your income is not enough to cover your annual obligations, and that means your capital base is being depleted each year that occurs, and that can really lead you down a path you do not want to follow. So just be cognizant of this ratio. And then quickly, cash flow leverage is really debt versus earnings. For this ratio, when you're comparing your total debt, which we're showing on the left here, with what your EBITDA is, you don't want to have, really as a general rule of thumb, total debt that's more than 5 times your earnings, your EBITDA level. That's an indicator that you're probably carrying a lot of debt relative to your steady state earnings. If it's one particular year where your earnings were off and the ratio is sort of out of whack, that's one thing. But if it's persistent year after year, then that's a sign that you may not be in a good position to weather an abnormally warm or cold winter. So you want to really know these ratios, and they're very quick. And using these calculations in the presentation, you can quickly come up with them and see where you fall on the spectrum. So what are some financial best practices? We'll run through these quickly. We have 7 that we like to go over with clients. The first is create a budget. I know a lot of you still don't do it. I highly recommend that you do create a budget, even if it's a basic budget. It's very important that you know where you need to be in order to hit your year-end goals. And when you have that visibility, it gives you the intestinal fortitude to make the right decisions when things get a little tough. When your competitors are doing things that you shake your head at, it allows you to just hold the line because if you don't do it, you're not going to hit your goals. Segment divisions, assume a normal winter, put controls in place to regularly track how you're actually doing on your margins that you build into the budget. Analyze the gross margin of your service and installation divisions, know what your targets are, and constantly analyze them and understand where you need to be. We always like to see gross margin on HVAC jobs be somewhere in the upper 60%, lower 70% range. And that's an area where we see a pretty wide discrepancy throughout the industry. And it's an area that we find that companies can pretty quickly correct if they hone in on it and target it. And remember, competition is just a data point. It's not the driver of your business. So, make sure that you're doing the things that you need to do for your cost structure, your business. We've dealt with a lot of skeptics as clients or initial clients who were skeptical and then became converts and have worked with us ever since. There are a lot of areas where you can squeeze profitability out of your company beyond just raising margin. There are a lot of areas where it can be done. And In the end, your customers are with you because they value your service, your reputation. Price is just one little piece of the puzzle that they're looking at. Step two, I always consider the use of debt or a lease to fund long-term assets. Notice that I said consider. I didn't say always use debt or a lease. I say always consider it. And the reason is it's very common in our industry for companies to have a mismatch of short-term assets and long-term liabilities. What I mean by that is when companies are sitting on cash, it's very tempting to say, I don't need to take on debt. I'm going to go out and just use my cash to buy what I need to buy, whether it's that van, whether it's doing a little bit of work to my bulk plant to upgrade it, whether it's buying the next pallet of propane tanks to expand. But you have to remember that every purchase of a long-term asset like that, a truck, a propane tank, a bulk plant, using your operating line of credit or cash weakens your company's liquidity position to some extent. So the current ratio can really help you in seeing, if I pull $100,000 of cash out to make this purchase, what is that going to do to my current ratio, and am I going to fall out of whack? And that's really an important thing to understand. Every decision like that is important. Remember that a line of credit typically is for seasonal working capital, meaning it's really there to drive short-term borrowings, short-term coverage of payments that you're making to fuel suppliers and parts suppliers. It's not there for long-term purchases. Watch out for what I call the propane wall. I've seen it over and over. I've written articles about it. It's something, it's a phenomena where what happens is a company will, for a couple of years, as you get into the propane business, pay for trucks, tanks, et cetera, out of cash, and it works for a while, but then you get to a point where suddenly your line of credit doesn't work. And that's because there was this general mismatch in short-term assets and long-term liabilities. As I mentioned earlier, liquidity is the most important thing to keep in mind, because your customer list, if you can't serve your customers, if you can't access fuel or parts to serve your customers, and they leave you, the value of your business declines rapidly, and we want to avoid that at all costs. The third item I want to just point out is don't wait until cash is tight to seek relief. I can tell you this from my perspective as a banker, speed kills. There are no fast decisions at banks when it comes to lending and extending new money. And when you approach a bank in the heat of the moment, it's late January, early February, and you're suddenly discovering that line of credit that was okay last year is not adequate to get you through this year. It's very frustrating for you as the dealer and the bank's borrower because everything moves slowly at a bank. And that's done on purpose. It's so that they're making the right decision and understanding why that need is there. It is very possible and very reliable to do forecasting before the winter, so you can understand what your company will likely need in a situation, and you can even do a little bit of sensitizing to see, okay, if the gallons are higher, if the price goes up by 25%, what's that going to do to my line of credit? All of that can easily be done now in late spring, early summer for next winter to understand what that need is. And when you have that information, it's much easier to go in with a well-crafted presentation to your bank and say, listen, here's the situation. My receivables have gone up. My inventory is expected to go up. I need a bigger line, and let's talk about what we need to do in order to get that in place. It's a very different conversation than a panicked call in January. Step 4, make sure that commodity price movements don't hurt your margins. We have plenty of other presentations on hedging, and my goal today is not to go over commodity hedging with you, other than to just say, make sure you're not speculating. Make sure you're hedging any fixed and cap price offers that you have out there, because you want to avoid what I call the best bad choice situation. That is, you went out with an offer, now you've got an obligation to your customer, but you haven't protected yourself. Market moves against you, and now you're burning time thinking, oh, geez, what should I do? Should I wait? Should I jump? And it just gets, it gets worse and worse. So you want to avoid that. If you sell it, hedge it. And that's my advice. I won't expand on that too much more at this point. Also understand that when you offer programs, that there could be a situation in particularly warm or cold winters where your assumptions about margin change. And you need to understand that because of the fact that you may not have hedged all of the gallons that you ultimately end up selling to those fixed price or cap price customers in a given month. And don't forget about a liquidated damages clause, very important. Step 5, diversify your suppliers. I work with a lot of companies who have 1, maybe 2 suppliers, and my first bit of advice is don't do that. Get several suppliers in, establish multiple relationships. Yes, some suppliers are more than others, but it's very valuable when you need that liquidity in the heat of the battle over the course of the winter, that you have these multiple supply streams, and it can really help to ease you. We have a long-term client. When we first got involved, they had really 1 supplier, and they owed them a ton of money. And over the last several years, we've been able to get them to a point where they now have 6 suppliers, and they owe each of those customers a little bit of money. So each of the supplier a little bit. So it's a much more tolerable situation for everybody involved, including the supplier. Step 6, watch that AR like a hawk. Establish tight controls. Constantly watch those buckets, particularly over the course of the winter and this time of the year right now, heading out of the winter, because as we all know, once it gets warm, people are saying, geez, I don't really need to make that payment too quickly because I'm not going to need another delivery till the fall. And that's a bad situation to be in as a dealer, particularly if your cash flow has been tight, if you have a weak current ratio, what have you. So you want to really be out in front of that, get the policies in place, and don't be afraid to lose a slow pay customer. If you're concerned that by tightening up your policy you're going to lose a lot of customers, I don't know if that's really the type of customers that you want to be serving. Step 7, and this is the final one, which will lead into our weather hedging discussion quickly. Heating degree days. Understand your profitability per heating degree day. It's really important to know what the impact of the weather is on your particular business. Every business has its own profitability per heating degree day. The weather is the single most significant risk to your business, so understand what a warm weather or cold weather scenario will do to your earnings. We've seen it several times in recent years. When severe warmth hits in key months, you just simply can't raise your margin high enough to cover costs. And as I mentioned before, competitors out there are not acting rationally, and it becomes very difficult to get the margin that you truly need in order to cover those costs. You've got to think about where you are as a company. Is your balance sheet strong enough that you can absorb a warm winter and perhaps losses that come from a warm winter? And you have to think also about what's the frictional and monetary cost of dealing with your financing partners. I've worked with companies that came to me because they're facing some financial challenges, and they've spent an inordinate amount of time dealing with suppliers and banks in order to get through the winter when they should really be focused on their operation and making money while the sun is shining, making hay while the sun shines. So, it's something you want to avoid. If you can avoid that situation, you want to do it. And weather hedging is a way to do that. So what is a weather derivative? It's a financial instrument that can be used as part of a risk management strategy to reduce risk associated with adverse or unexpected weather conditions. There are weather hedges for everything out there. We've seen them for rainfall, snowfall, combinations of rainfall, snowfall, price of fuel. They're derivative products. You're only limited by your imagination as to what you can do. What we commonly see and what our clients commonly use in the fuel industry are heating degree day options. And what those are is really establishment of a strike price based on the number of heating degree days at which a payment will kick in. So if it's warmer than a certain strike price, a certain number of heating degree days in a particular defined period, they will start to get a payout based on the dollar per heating degree day that they selected. And that dollar per heating degree day comes from their budget. It comes from what are they targeting to make in this upcoming winter. So it all, again, goes back to budgeting and understanding how this puzzle fits together. Just some quick terms. Dollars per heating degree day is how I most commonly see weather hedges priced out. Put options, in the same way you'd see them with heating oil, really gives you protection if it's warmer than normal. The premium is what you pay to purchase the hedge. Some hedges may have a limit, meaning they won't pay out more than a certain amount, and that helps to keep the premium lower. And you may have a seasonal hedge for the winter that might cover, for example, November through March, or you might just have a monthly hedge. So step one, when you're looking at weather hedging, what you want to do first is really understand your particular company's projected gross profit per heating degree day. So use your budgeted gallons, calculate your projected liquid gross profit for weather-driven sales. So really what you're doing is just focusing in on those gallons you sell that are impacted by the weather. Typically heating oil and a good chunk of propane would be impacted by the weather. You may also want to look at service as well and make an assumption as to what service, how that can be impacted by the weather. It gets a little more difficult to calculate it, but we do have customers who take that into account in their calculation as well. Once you have your number, what your company's number is, and we'll go through an example here in a minute, you can obtain an average monthly or seasonal heating degree day history for your area. There are weather stations all around the Northeast that people trade at. The common ones are Newark, LaGuardia. They certainly extend up into New England, into Pennsylvania, all around. So there are plenty of weather stations that we would use as the reference point. Then you just simply divide your gross profit into the number of heating degree days for that period, and that's your estimated value of a heating degree day to your company. So as an example here, if you are targeting $1 million of gross profit from November to March, and the average total heating degree days at that local weather station for the November to March period is 4,647, you would have a gallons per heating degree day target of 215. Okay, so why is that important? It's important for a couple of reasons. One is it allows you to determine the point where your profits are going to drop off and drop below your fixed costs. Second, you're going to be able to understand better the impact of adjusting margin targets to maintain your profit. If you are not increasing your profitability as your gallons are decreasing due to warm weather, this number is going to drop. This gallons per heating degree day will drop. So you have to always keep that in mind. And most importantly, for purposes of weather hedging, it gives you a quantified level where you can now go to a trading firm and say, I would like to protect this level of earnings per heating degree day at my local weather station. And with that information, now you're armed with what you need in order to obtain a quote. So the next thing is determining where you want this weather hedge to kick in. You can establish a heating degree day strike at any level, and the strike, remember, is just the number of heating degree days where it will start to pay out. There's no one-size-fits-all. It's really dependent on your company's circumstances. If your company is facing some challenges and has a weakened balance sheet, you may not want to really build in much leeway at all because you just simply can't absorb a big loss from a warm season. If you have a very strong balance sheet, then maybe you have a weather hedge that doesn't kick in until you're at really extremely warm levels. So as an example, you can determine, hey, maybe I want my weather hedge to kick in at 3% warmer than normal for this period, or 4% or 5%. It's up to you. But all of this should be derived from your budget and an understanding of your ratios and your ability to weather a warm period. I would certainly advise you to assist, if you need assistance, to contact a commodity trading advisor to talk about the costs and risks associated with it. If you do that, just as an aside, the regulatory requirements are that you would have to acknowledge the risks of having CTA advisory services, understanding what the risks are of trading through a disclosure document. So just be aware of that. Step 3, once you have this number and once you've developed your strike, you can now go to a trading firm and you can say, okay, here's what I'd like to get a quote on. And the quote that they provide you is called the premium. So that's really the sunk cost, what you're going to pay for this hedge. Whether the hedge kicks in and pays you back or not, you have paid the premium, and that's a loss. That's an expense that you paid. And typically clients who do this have just built that cost into their margin, and it's covered by their regular margin. It might only be a couple cents per gallon, but they know that they've covered at least the cost of doing the hedge in their margin. Don't be afraid to request quotes on multiple scenarios. Some people like to look at, okay, maybe I'll do it for a 3% warmer than normal winter, and maybe I'll look at it for a 5% warmer than normal winter and understand what the impact is from a premium standpoint. Some customers may also look and say, I don't need a full winter protected. I just want to protect January, or I want to protect February, or I want to protect just January and February. So it's all very easy to tailor to your particular desire. So once you have that, you shop it around, you look at what the cost would be to do it. If you like it, it makes sense, and you want to move forward, you would give the trading company the permission to enter the transaction. They would send you a confirmation, and you're off and running. So let's quickly look at 2 examples about how this would work, just to give you some more concrete examples here. The first is looking at a situation where we have a targeted December through April 10-year average of 4,647 heating degree days. So that's the 10-year average at this particular weather station. The strike that was established by the client was 4,508, and that was established because they said we can absorb up to 3% warmer than normal winter, but anything beyond that we're really going to have trouble collecting from our customers in the form of an increased margin. In this particular scenario, the weather turned out to be 1% warmer than normal for this December through April period. So in this example, it was 4,600 heating degree days for the winter, which was fairly close to normal. It turned out that this was actually above the strike level of 4,508. So there was not a payout. So because it did not get warm enough for the hedge to result in a positive settlement, there was no payment back to the customer. But that really is a good situation for the customer, for the dealer, because that means that they had a normal winter and sold the gallons that they expected to sell. It's always, in my opinion, better to not have to get paid out under a weather hedge. The weather hedge really is there as a backstop. So in this scenario, there was no settlement paid to the client because the strike price was not met. They did spend the money on the settlement, on the premium, which was in this scenario $25,000, just as an estimate. So their total payment was $25,000. They did not get anything back. So that is how in a normal winter, or actually in a colder than normal winter, a straight heating degree day put option would work. Now let's look at the same parameters, but in a different weather situation. So we have the same targeted average heating degree days for the period, and we have the same strike at 3% out. But in this case, it was 10% warmer than normal, and the heating degree days only totaled 4,182. So this company was actually 326 heating degree days, quote unquote, in the money. And what this weather hedge did in this scenario is it paid them back $215 for each of those 326 heating degree days that they missed, for a total of $70,000. So they received a settlement of $70,000. They paid $25,000, which again, remember, most companies will get back through the typical margin that they're charging the customers. And their net expense, or their net income from this whole thing, is actually positive $45,090. So they they made $45,000 on this trade, which then went to replace lost profitability. So that, in its simplest form, is how weather hedging works. Just one thing to point out, weather hedging, like all hedging of commodities, it does involve risk of loss. There are many structures that you can enter. Oftentimes, people will look at collar structures and get a little more creative with structures that may result in a payout to them, but could also result in the dealer having to pay the trading company if it's, for example, much colder than normal, and that type of structure is used to reduce the premium. So there are risks associated with those types of trades, which your commodity trading advisor can walk you through. But I just want to point out that you need to go into these with open eyes and understand where the risk lies with certain of these. So we've got about 10 minutes to go. This is just a recap of the financial best practices. And also in this presentation, I have included a summary of some key ratios. These are really the mathematical formulas of what I explained earlier in the presentation, but I wanted you to have these along with the goals and target of where you want to be. And I'll just point out quickly, we've got the current ratio, which we went through, and we've got debt service coverage ratio. There are two different cash flow leverage examples. I went over total funded debt to EBITDA in the examples. There's also one called senior funded debt to EBITDA, which is really just your senior bank debt. That you typically want to see lower, typically 3 or 4 times or less, and I've included that in here. If you have any questions on any of these ratios or any of the presentation, you're certainly free to contact me. I'll show you my information at the end of the presentation. Actually, I'll show it to you now, along with my glamour shot. And I'm happy to answer any questions that you might have at this point.
Excellent, Jeff. Thank you very much. And to Jeff's point, feel free to ask questions using the chat or question feature in GoToMeeting. We did get a couple in. First one, my bank has been unwilling to increase my line of credit. Any suggestions on how to approach that scenario?
Yeah, I mean, that's sort of a loaded question. There could be a number of reasons as to why a bank would be hesitant. I'd say, my advice in that situation is, don't just send your financials or make the request in a vacuum. Really take some time to look at your current ratio and understand, how that balance is. Are your receivables and your inventory, which are your main short-term assets, how are they in balance or out of balance with the borrowing on the line? If that's a situation where those are in balance, then I think you have a perfectly legitimate reason to go to the bank and say, my need for a line is driven by changes at my business, which are positive. We're growing, we're selling more fuel, we're buying more inventory to support more HVAC work, whatever the case may be. So you've got to reframe that discussion with the bank. If it's a situation where the bank is just refusing to go above a certain level, and you see that your current ratio is healthy, and the bank is just reluctant to go above it, then maybe it's time for a new bank. Maybe that's just not the banking relationship that you should have to support continued growth at the business.
Very good. What do I do if my current ratio is weaker than the 1.0 industry average that you indicated earlier in the webinar?
Yeah. So if that's the case, if you do the calculation and you find out that your current ratio is weak, and typically by weak, if you're below like a 0.8 or 0.9 times current ratio, that's definitely time to start, looking into it. Maybe talk to your advisor or accountant about some steps that you can take. But if you find yourself in that position, then it comes down to understanding how you got there, what drove it. I've seen a lot of examples where companies that got into propane, for example, spent a lot of money to get that division up and running. and did it out of cash or using a line of credit. And over time, they may have started with a nice current ratio or liquidity position, but it got weaker and weaker and weaker. So it wasn't a one-time situation. It happened over several years. And if that's the case, and that's what's driving it, it really is actually in some senses easier to go to the bank and explain that we've just fallen out of balance because we didn't have the right loan facility in place in order to get things constructed if it's a bulk plant, or buy the trucks we needed, or buy the propane tanks we needed for our clients to start building that base. And that gets back to just understanding, maybe that would have been better matched to a long-term loan facility or a lease. So if you're finding that you have a weak ratio, I think I would start there, and that's something that we help people with all the time. It may be a situation where your company is just kind of underperforming in the earnings level. It's not earning what it should be earning for a company of your size. So those are all things we can look at and help companies determine.
Very good. Last one we got in here, and we'll wrap up. If there's anything else that comes in afterwards, I will connect them with you, Jeff. You referenced individual months on a weather hedge. Is there a downside to doing this in regards to picking 1 to 2 to 3 months per year?
I'd say it really gets into, I think, the sophistication level of the company that's doing the hedge, and what your ultimate goals are. Most of the people that we deal with, they just want to have some protection in place so that if there's an extended warm period, they know that there's a backstop in place, and they will get some settlement if it's chronically warm for a couple of months. And that's, I think, most people are in that camp. So for that reason, we commonly advise people to just structure a seasonal weather hedge that goes from like November to April, or October to April, something in that realm. Sometimes, though, particularly for larger customers who have highlighted certain months that are most critical to them, they may decide, I just want to hedge this particular month or these 2 particular months. I think that the thing to just keep in mind is that when you do that, the cost tends to go up, and for shorter periods. And the reason is the odds of it paying out go up, because the standard deviation in weather changes over the course of a heating season is about 10%, maybe a little higher. But in a particular month, it could be 20%, particularly in shoulder months. So, those big swings inside of one particular month lead to higher premiums to protect the shorter period of time. So it's just a consideration to take into account. Some people like shorter weather hedges, like just doing it by the month, because they know that 1 month is not going to sting them. Because if you do a seasonal hedge, you could have all normal months but one really warm month, and over the course of the winter you may not reach your strike price and receive a payout. So it's really a matter of preference. So I just to sum it up, keep in mind that the cost can change because of the standard deviation in any particular month versus over the course of an entire winter.
Okay. We did have another one come in here, Jeff. You were referencing suppliers and the benefits of having multiple suppliers. Do you recommend dealing with multiple banks or more than one bank?
Well, that's typically a challenge, and the reason is, particularly for more comprehensive relationships, banks want to have control of everything, so to speak. So if things ever went sideways and they had to liquidate their assets, which is very, very rare, but if it had to happen, the way bankers are taught is they want to be able to control all the assets, including the receivables, the inventory, and the longer-term debt as well. That being said, however, there are certainly times when you could have a banking relationship for maybe it's a mortgage and maybe it's a line of credit, but you're looking to expand into propane and you want to get a lease on propane tanks or a lease on a truck or a separate loan on a truck, in that case, it may benefit you to separate that out and deal separately for those particular assets because your bank doesn't necessarily care or like those assets. A lot of banks don't know what to do with propane tanks that are spread all over the countryside. Other banks and other financing companies are perfectly comfortable with them. It's a matter of preference based on the banks. So I'd say it's more difficult to have multiple banks because of that. And if you enter a situation where you've got one bank that does a line of credit and another bank that does a term loan or a mortgage, you may get into what's called intercreditor agreements, which means there are agreements struck between the banks in a situation where there has to be a liquidation, and it just adds a layer of complexity to it. So my advice is it's generally easier to just have it all under one umbrella, but it can certainly be done to have multiple banks.
Very good. Makes sense. With that, it is 10 o'clock, so we're going to wrap up here. Jeff, thank you very much for your presentation today. It was very informational. I'd like to remind everyone that we're going to be taking a month off on the webinar series next month due to the 4th of July holiday, and we will be back on the first Tuesday of August. So with that being said, thank you again, everyone. Jeff, have a great day.
Thank you, Ted. I just want to let everybody know if you'd like to email me, I'd be happy to send you a copy of the presentation.
Very good.
Thank you.
All right, everyone. Thank you. Take care.